Takes us to our talk of the tape, the outlook for stocks in this new year, and why one closing bell headliner says the risk reward for investors is now skewed positive. Let's welcome him in. He's Adam Parker. He's the founder and CEO of Trivariate Research and a CNBC contributor with me, as you can see, at Post 9. You're the headliner.
Yeah, baby.
Like
Let's do it.
So I know you've gotten more positive, but risk reward is now much better than it was, even with that big rally towards the end of the year. Why?
Well, as you know, last year we were positive too. I mean, it went up more than I thought.
Not this much.
Went up more than I thought. But I think the skew positive to me comes down to three things. One, I think the average company has a good chance their margins expand. And stocks work when gross margins expand. So that's one. Two, I don't think the Fed's going to cut 6-7 times between now and January 25. If they do, it won't be skewed to the positive. It won't. I don't think that'll be necessary. I think.
Oh, but you think if they do cut that many times, it's because they
things got way worse.
They got bad.
Yeah. So I'm in the. I don't like the view of good news is bad for stocks. That makes no sense beyond like one day. I think good news will be good for stocks. And I think the third point would be, I think there's a reasonable chance that earnings grow for several years in a row, like they did from 2010 to 2019. We're a few years in that process now, and what looks a little expensive at 20 times forward or 19 times forward to get 10% upside, maybe we'll look a little more attractive as we start believing 25 earnings are above 24 and 26 are above 25. That's my base case, and I think that probably means a skew 6, 12, 18 months out is higher.
Basically, margins have troughed in your,
it looks like
in your point of view, and that's ultimately that ends up being the key to everything.
Yeah, stocks work when margins expand. And I think that's the key. Obviously, it depends on pricing and mix in certain industries. It depends on input costs. But I think a lot of businesses are going to see pretty good productivity, lower input costs from commodities and materials, less, wage inflation. It's wage inflating at a lower rate and can be offset by productivity. Currency could help a little during earnings. So, dollar kind of weakened across the board last few months. I add it all up, and I think probably margins expand.
Does it matter how many times the Fed really cuts or when? I mean,
no.
I know you said if they have to cut 6 or 7 times, it means things get bad. But, given where inflation expectations are, we got that read yesterday. That was good.
Yeah.
It's trending in the right direction.
Here's the challenge I have, okay? When I look back I wanted to take a step back, come into the year at Outlook we just did and say, okay, if the ECB and the Fed are going to be accommodative, I don't want to be a jerk and fight that. We've learned the lesson. Don't fight, the Fed. But when you go back and you look at the last few times that's happened, it was TMT bubble, it was financial crisis, and it was COVID. Are you sure that this is the exact same period? It doesn't feel. This feels more like a mid-cycle adjustment, or we had some sort of. It doesn't feel to me like it's an acute problem that's going to need massive accommodation. So I don't think we're going to get 6, 7, cuts unless things get way worse. And my base case, from looking at economic activity, leading economic indicators, the strength of the consumer while eroding is still okay. Financial conditions. When I add all that up, it doesn't seem like we're headed into a COVID or GFC
But Fed funds are probably higher than right now than where they really need to be relative to where inflation is going. You think so?
Yeah, I think on a normalized basis, a 4% 10-year could be okay. The front end's trickier. We'll see. I think most people believe the curve's got to uninvert, right, at some point. When you go back again, there's insignificant sample size to evaluate the uninversion playbook, but generally it's bullish for equities too, right? So I think what you need to believe is the 2-year yield becomes below the 10-year yield. The economy is slowing but not tanking, and the average company's margins can still grind higher. If that's the case, equities will be, of course, they'll be 10%.
But I mean, isn't
higher.
the risk, though, that the Fed waits too long to cut? How much risk do you think there is in that? Right? They snatch defeat from the jaws of victory because they wait too long. Like they waited too long at the front end, they wait too long in the back.
So I would answer that differently, which is I'm not sure how wrong they were on the front end. The part that I would be more critical of was, I think, still in early 2022, the balance sheet, they were buying tons of mortgage-backed securities when housing was on fire in every market.
So what do you mean that they weren't too wrong in the front end? You've been criticizing them for that since we've had these conversations.
Well, I guess I don't know what they do, but I guess the reason I paused is because I actually don't want them to start cutting crazy. What I want them to do is, what I know is the probability they are accommodative is a lot higher than the probability they hike, and I like that dream right now. I like the dream of eventual accommodation. I'm not sure the reality of it is going to be awesome if it's because the economy is eroding.
No, but it's because the inflation is coming down.